are in the schedule, and I can show you that in a moment. Welcome those of you who have just downloaded this video online. For those of you who haven't downloaded one of these before, my name is Brian Clark, and I am your instructor for this session, Part 14 of Fundamentals of Income Tax, where we're going to be looking at Chapter 12 of the textbook. This is the British Columbia session, where our focus on provincial topics is going to be on British Columbia. But my students here just had an interesting question about the exam, because someone was wondering if we needed to get 100% on the theory exam in order to pass the theory exam. And that's not true. A pass mark for the theory exam is the same as the entire course. So 70% is a pass. 80% is what we would be looking at to consider you for employment with H&R Block. The key thing being 80% for the entire course is the idea. So if you got, say, a 79% in the theory exam and your assignments were all 96%, then, we would take that into account. But there is something to be aware of in U-Learn, and I'm going to mention it here because I think mentioning it frequently is a good idea. When you write the theory exam, you can take it twice. You are able to take a second attempt of the theory exam. Now, the trick is that in order to allow the software to do that, the platform that we use, you have to be marked as it will say that you failed the first attempt. This simply means that you failed to get 100% on your first attempt, and you can attempt it again. We brought this in because some people were complaining that they had passed in previous years, that they had passed the exam with, say, 81% or 83%, and they wanted to try to take it again to get a better mark, and the software wouldn't let them do that if they had passed the exam. So currently, and it is my understanding this is still the case, it will show, if you score less than 100%, it will say that you failed the exam. All that means is that you failed to get 100%, and you are able to take a second attempt if you want. But I did have many alarmed messages from students last year about this, so I just want to assure you, if you've gotten 99% on the exam and it says that you failed, you have not failed. You just have the option to shoot for 100 if you really want to. Yeah, exactly. Well, with the theory exam, I'm not sure because I don't write the exams as such in the same way you do. But with the theory exam, you do not write the same exam twice. The questions you get are somewhat randomized and drawn from a bank, and they will also be in a somewhat random order. So I'm not sure if it displays which particular ones you got correct or not, off the top of my head. Right? That said, it'll be very clear if you have 100% or not. Anyway, we don't need to worry too much about the final exam, the theory exam at this point, because that's still a couple weeks out. But it is a good time to remind you all, and those of you out in the internet there, to do take some time, go back, read some of the previous chapters with your new understanding, study, just like you would for any other exam. Make some notes, prepare some strategies, and, with some preparation, it's not too scary of an exam at all. The questions will not be exactly the same for the second attempt, Mohammed. And you should be careful because some questions will look similar, but you do have to read them carefully because some are similar but slightly different. And again, this is to discourage things like students sharing answers and things like that. So no one writes exactly the same exam. All right. So that said, let's move on to our material for the evening. So welcome back, everyone. Here we have all survived Halloween weekend, which was quite rainy in the lower mainland here where I was. But and now we've had the time change, so it's quite dark out. But I hope everyone had a good, refreshing weekend. As always, guys, if you happen to have any connection issues or anything like that, just remember to follow the checklist here. And as well, sometimes WebEx will accidentally mute the presenter, or I might nudge a button or something or go mute. So if it appears that there should be sound and there's not, do feel free to say something in chat, because if it's just you, that will be clear. But if the entire class can't hear me, then it sounds like something's gone wrong at my end, and then my best way of realizing that is seeing a bunch of messages in chat. All right. As always, questions are very good, very important to making the class as rich as possible, particularly for the people who have just downloaded this and won't have a chance to ask any questions. It's good if you guys ask some questions if anything is unclear. Remember, if you think something is unclear, you're probably not the only one. Okay, so in our previous class, just to review, we didn't quite finish it last time, but we got very close to the end. So we talked about topics of interest to senior taxpayers. So we talked about the types of income typically received by seniors, Social Security income such as old age security and CPP income, the differences between the two of those. Old age security in particular, like employment insurance, sometimes has to be repaid if the senior's income was over a certain level for the year. And then we talked about how to categorize and deal with various other types of retirement income, and whether it is treated as pension income for tax purposes or some other type of income, because this relates to the pension income amount, which is a non-refundable tax credit, along with the age amount, both of which can be shared between spouses. And we also touched on pension income splitting, which is calculated on a form called the T1032. Now, I'll hold off if you guys have any questions, because there was one last topic from last time that we didn't quite get to, and I wanted to make sure that it wasn't particularly rushed. And that is installment payments. Now, installment payments technically are a topic which applies to all taxpayers, but they are particularly of interest to seniors. Installment payments, well, as a general term, an installment payment is any type of advance payment that you make on your income taxes. So if you send tax directly to the government during the year for that year's taxes, so that is, if you send some of your 2025 taxes to the CRA during 2025, that is considered an installment payment. You are making an installment payment on your estimated tax bill for the year. However, for some individuals who tend to have a lot of tax owing at the end of the year, the CRA can require them to make installment payments during the year. In the same way that when you are working at a job, the employer will deduct some money for tax from each paycheck and send that directly to the government to help keep the government running. So too, for other taxpayers who the government predicts are going to owe a significant amount of tax for the year, they are required to make installment payments during the year. The rule is then, if you owe more than $3,000 in the current tax year, and your net tax owing for either of the two previous years was also over $3,000, then the government will require you to make installment payments. Now, there are three methods to calculate the installment payments that are required. In practice, this is rarely necessary because the CRA in these situations will send out installment reminders telling people what the amount is that they should pay. Just for reference, there are three different ways, however, to calculate your estimated installments. There's the current year method, where it's based on your estimate of the tax for the current year. There's the prior year method, where it is based on your estimate of the tax based on your previous year. And then installment reminders from the government, which are based on the tax owing from the two previous years. And that helps to average it out in case you had 1 year where you owed a lot of tax and 1 year with relatively low tax. Now, If an installment payment is not made when it is required, the CRA does have the option of assessing interest if the payments are late or simply not paid, or they are insufficient. In practice, in many cases, because there are these three different methods of calculating installment payments, what I observed is so long as the taxpayer is making some sort of installment payments and some effort to comply with the installment payments requirement, it is relatively rare that a taxpayer is making some installment payments would be assessed interest. But it's certainly possible for it to happen in other cases, particularly if the installments are quite large. Now, installment payments, there's various methods of making payments to the CRA. I think the CRA lists something like 14 different methods of making a payment to the CRA on their website the last time we looked. But in particular, installment payments can be made using a dedicated form called an installment remittance voucher. But it can also be done through the various methods such as online banking, MyPayment, pre-authorized debits, credit cards, and so on. In general, when you make a payment to the CRA, it is important to select whether this is a payment on the previous year's taxes, that is what you're currently owed, or an installment payment on the following year. Sometimes if the CRA receives a payment and they do not know that what you owe for the previous year yet, so for example, you calculate your tax return, you realize you owe some money, and then you run across the street and send money immediately to the CRA before they process the return, the CRA may not understand what that payment is, and they may consider it an installment payment instead. So I have seen this kind of ships passing in the night phenomenon where somebody thinks they've paid their taxes, but the CRA thinks that payment is for next year's taxes. My current understanding is that if you go on my account, you are able to redirect payments that have been received by the CRA from the installments side of the ledger to your current account balance. I haven't confirmed that, but I have been told that. And even if that's not possible, it can usually be cleared up with a phone call to the CRA, but it is something to watch out for because it is a bit of a hassle. Now, all installment payments that are made, whether they're required or not, so any kind of payment that you send to the CRA, which isn't a previous year tax payment, they will consider it an installment payment, and all installment payments are entered on line 47600 of the tax return. Okay. All right, good stuff. Oh, you guys are seeing the slides, Grant? Everything okay there, it looks like? All right. All right, fantastic. All right, let's move our chat window up there. Yes, I sometimes have to move the chat window a bit down so I can see the text. There we go. All right, so just to wrap up chapter 11 then, we'll just give you a poll question just to see how well you remember from last time. So nothing too complicated here, but just to refresh your memory. So last time, remember, we talked about Form P1032. This is the pension income splitting form. So who has to complete Form T1032? Is it the pensioner, the pension transferee, both, or neither? So give you a minute and let me see what you think. So remember, the pensioner is basically the person who receives the pension, receives the money in the first place, and the pension transferee is the person who the money is being transferred to for tax purposes. They're also sometimes referred to as the, hang on, yes, the transferring spouse and the receiving spouse, or the transferring spouse or common law partner and the receiving spouse or common law partner. Those terms are interchangeable with pensioner and pension transferee. All right, and there we go. Good stuff. Exactly. So I think the terms are relatively clear, whichever terms you are using. So just understand that they are pretty much interchangeable, and you will see both of them. Right, WebEx is just tabulating the results. Very good. And so most of you got the correct answer, and good. So the correct answer is both. Both the pensioner and the pension transferee have to complete the form. Now, what this means is when I'm doing tax returns involving pension transfers, that both spouses have to sign each copy of the form, and then each of them will get a copy of the form, and each of them will have a second copy of the form included in their file and sent to the government. So in other words, they have to sign these in quadruplicate at least, and so it's a lot of signing when I do it. Usually I make sure that they have different colored pens and use a lot of arrows to indicate which line each of them should sign on, and we get a bit of an assembly line going. When we look at chapter review problem 11-1, we will look at an example of a pension transfer. And we are going to look at chapter review problem 11-1 after we finish the main lecture, but before we do chapter review problems 12-1 and 12-2. From teaching this session yesterday, I think this will work better for the overall flow. So for any of you listening who are just wanting to get straight to 11-1, you'll want to skip ahead in the recording. But first, we are going to be looking at chapter 12. Chapter 12 in the textbook is what we call family situations. And essentially, chapter 12 is where we're going to build on the concepts that we learned in the chapter about dependents and spouses. In that chapter, we kept things simple by looking at situations where the marital status or the number of dependents was consistent throughout the entire year. We did not get into the complexities that can arise around partial year situations or where there are custody issues with dependents. So tonight we're going to be getting into these more complex situations and building on what we've already discussed. So tonight we're going to look at in a little more detail what happens when you get married or establish a common law relationship and its implications for the tax return in the year of marriage or establishing a common law relationship. We're also going to look at what happens when a relationship ends, either through separation or divorce during the tax year. We're going to look at the various technicalities around legally required support payments of the different sorts and the effects those can have on the return. As well, those payments themselves can sometimes be treated as income. So they are deductible by the person who makes the payment and taxable in the hands of the person who receives them in certain circumstances, which we will spell out shortly. And we are also going to talk about adoption expenses, which is you will see, a credit that can be claimed when a child is adopted. We are also going to look at childcare expenses, which is a deduction with some I don't want to say complex, but at very least stringent rules around who can claim the deduction, as you will see. And we're going to look at other personal amounts and the effects on them of what we've seen. We're also going to look at some refundable credits, the GST, HST credit, and the Canada Child Benefit, and how those are affected in the year of a marital status change, right? So personal amounts here, we're talking about what happens in the year of a marital status change there. As well, we're going to touch on shared custody arrangements. In particular, what happens when custody is a nearly equal split during the year, rather than tilted all the way to one parent or the other. So, our learning objectives then, and remember, in the textbook, these learning objectives are always at the beginning and end of each chapter. So if you are reviewing a chapter or you have missed some of the presentation and you want to help focus yourself on what should I be taking away from this material, that is the idea behind the learning objectives. So at the conclusion of tonight, you should be able to discuss the tax consequences if there's a change of marital status in the year, how we handle support payments, specifically when they are taxable to a recipient and deductible by a payer, and how to enter those on the tax return. You're also going to be able to determine the eligibility for adoption expenses, how those are claimed. As well, you're going to be familiar with the rules around deducting childcare expenses and how to complete Form T778 to calculate those expenses, as well as generally being able to explain the effects of marital status changes on a taxpayer's eligibility for various personal amounts and refundable credits such as the GST, HST credit, and the Canada Child Benefit. All right, so on that note, let's talk about a change of marital status. Now, last time we talked about what constitutes someone being a spouse or common law partner and the difference between that. And this is important for tax purposes because a change of marital status will immediately affect personal amounts and tax credits. Now, some of those are not going to come into effect until you do your tax at the end of the year, but for things like refundable credits, a change in your marital status will immediately change your family net income, which of course is what your GST payments and your Canada Child Benefit payments are based on. So it is therefore important to let the CRA know as soon as possible about marital status changes, either via Form RC65 or My Account, or by contacting the CRA by phone. Now, someone's last name may change after informed of the name change. Oh, and just to mention, marital status changes. This typically can only be done at tax time by a tax preparer. During the rest of the year, a tax preparer cannot change someone's marital status or other personal information using the represent a client feature. So, if you accidentally, if there's a software error and someone goes in as common law when they should be married, or vice versa, you have little choice but to send a letter to the CRA and say, whoops, there wasn't actually a change. Can you push that back? And this, of course, can be tricky. And if it's a change, it's a little different. You can just send in the form notifying them of a change. But just to correct a change which did happen, you can send in the letter to let them know about that. Oh, one last thing about somebody's name may change after a marital status change. This can definitely be updated at tax time. Often, depending on the software package, though, additional steps may need to be taken. Typically, normally, you need to trip a flag that notifies the CRA that this is a new last name. Otherwise, the CRA may reject it as being, oh, this last name doesn't match. So most software will have some provision to do that updating at tax time. Now, just to review, when you are getting married or establishing a common law relationship, the rules we should remember from previously. So, for getting married, the date of the change for marriage occurs on the wedding date itself. This is a legal ceremony. There's a legal agreement involved, so that is very clear. But for a common law relationship, as we remember, this occurs after 12 months of continuous cohabitation with someone who you are in a conjugal relationship with, or as soon as the couple starts living together as parents of a child, using the expanded definition of parents and child that exists for tax. Now, establishing the beginning of a common law relationship can be difficult, but it can help to think that there are basically three simple scenarios. First case, if there's two individuals without children, then it's cohabitation of 12 months. So when they start living together, and if they stay together for 12 months, then at the end of 12 months, they are considered common law. If they separate during those 12 months, if the separation is less than 90 days, this does not constitute an interruption of the 12 continuous months. If, however, they separate and someone goes to live in another country for 6 months or something like that, that would reset the clock. Now, the second scenario would be you have two individuals that are parents of the same child, either by birth or by adoption. So in this case, they will either immediately become common law upon moving in together, or if they move together and the child isn't there yet, they will become common law when the child is born or an adoption is finalized. And again, we're using the expanded definition of parent and child here. So other scenarios are possible as well. It might not necessarily be a legal adoption, for example. The third scenario is the fuzzy one. So this is where you have one individual who's the parent of a child, either by birth or adoption or otherwise, and the other is not a parent of the child. So in that case, the second taxpayer will only be considered the parent of the child if the child is wholly dependent on both partners for support and both the taxpayer and the partner have in-law or in fact custody of the child. Now, if the conditions of the extended definition of parent are not satisfied, then the cohabitation for 12 continuous months remains in effect. So no matter what the scenario, it's a 12-month clock, and unless it is interrupted by a separation of more than 90 days, at the end of the 12 months, you are considered common law. And yes, that has been a surprise to some of my clients sometimes who are unfamiliar with the rules. Now, Beanish asks, does this apply even if one partner moves temporarily for a job purpose? Hang on, Valerie. So my reading of it is that a separation of longer than 90 days does not necessarily need to be due to a breakdown in the relationship. If they are physically living apart, they are not physically living together. So if you go to another country for a job and you're living there for 6 months, then I think that would be considered an interruption of the 12 continuous months. The key thing is they are not living together at the same address. Do they have separate addresses, right? Now, if someone is in temporary lodging for a work camp or something and they don't have a separate address and they're still using the old address, that would be different. But if they move away, have a separate address, and that lasts more than 90 days, that I feel would constitute an interruption. And Valerie, you're asking about the child. Uh, so custody and control is the phrase, and both taxpayers will be supporting the child. So it wouldn't have to be, say, custody in a court of law sort of sense, but they are both treated as responsible adults for this child. Then they would both be considered parents of the child. Yeah, support, custody, and control. Right. The phrase is custody and control, but it's not necessarily full capital C custody, which you might see when a couple breaks up. More about that a little later on. So separation in the year as a marital status. Separation as a marital status, as opposed to a physical separation, which might interrupt the 12 continuous months if it's longer than 90 days. So separation in the year as a marital status occurs when there is a breakdown in the relationship, and that breakdown lasts a certain length of time. Separation, divorce is the full formal legal version of separation, just as marriage is the formal legal version of common law. Separation here as a marital status must be due to a breakdown of the relationship, and it can be formalized by a court order or written agreement, or it can occur by mutual consent or simple desertion without a written agreement. So if someone's spouse or partner simply leaves them, never to return, that would constitute the same. Now, in either case, the CRA should be advised of the marital status change after 90 days of separation. Now, there are some cases where it may be ambiguous when the 90 days begins. So I think you can imagine a scenario where you have a couple and one of them goes to work overseas, and at first it's a long distance relationship, and then it kind of slowly dissolves over time. It can be hard to determine sometimes when the 90-day clock starts. In most cases, though, it should be relatively clear. For the marital status of separation, though, again, for tax purposes, right? It's not due to a breakdown of the relationship, and it also does not necessarily need to include December 31st in some situations. So let's say, for example, that someone separates from someone in November, and then, but in that case, by December 31st, 90 days haven't gone by. So their marital status on the tax return for that year might show as married. The separation, though, would not come into effect until January, 90 days after the initial departure. So, but for some purposes, right, but that would still be considered adequately separated for some tax purposes. Now, the 90-day requirement, just to be clear here, it applies only in certain situations, but it also applies equally to married and common law couples. The only rule that is unique to common law couples is that a separation of less than 90 days does not constitute an interruption of the 12-month clock. For any other purpose, the requirements are the same for both common law and married couples. All right, so this is how we define separation. Support payments then come into play when someone is paying support to someone's former spouse or common law partner, or the taxpayer's children, or a combination of both. Any other type of legally required payment is not considered a support payment for tax purposes. Now, support payments may be taxable to the recipient and deductible by the payer if certain requirements are met. The rules for this changed around 1997, so we are going to be mainly focused on the rules as they exist today. In general, though, for support payments, written agreements, court orders, or amendments that have specifications for spousal support, as opposed to child support, anything dealing with spousal support needs to be registered with the CRA using a Form T1158. Now, there are, for certain older agreements, it is necessary to register with the CRA using a different form if there is child support payments involved. But for anything since 1997, the Form T1158 is what's mainly required for anything involving spousal support payments. Child support payments should also be registered with the CRA, but do not require this form. Now, when support payments are made, the rules are that all support payments received, whether taxable or not, are reported on the return, and all support payments made, whether they are deductible or not, are reported on the return as well. All support payments received are reported on line 12799 in the income section, in the total income section. All support payments made are reported on line 21999 in step 3 of the tax return, the net income section. Taxable support payments are included as income on line 12800, and deductible support payments are claimed on line 22000. Oh, question from Muhammad. What will happen if one of the partners dies? The 90 days rule will be applicable in the same manner. No, that's a good question, Muhammad. Um, I don't want to seem fuzzy here. If one of the partners dies, that's kind of a unique situation. The It would really depend on the situation. In this course, we're not going to get into the technicalities around a deceased taxpayer because deceased taxpayers have a lot of additional complexities and issues around them. There's additional paperwork to file. The tax return in some cases is slightly different. So in a basic course like this, we're not getting into deceased taxpayers too much. In general, though, if I would say that if someone passes away in that 90-day period, then the separation would not be considered to have taken effect. More than likely, then what would happen is their status would shift from common law or married to widowed for the surviving taxpayer. Yeah, yeah, widow is what is used in that case for men and women. But again, I want to stress deceased taxpayers are a much more complicated thing, which we don't want to confuse things too much at this level with. All right, but that is an interesting question. Right now the question that you're probably wondering is what makes a support payment taxable deductible? Since 1997, only spousal support is taxable deductible. Child support payments since 1997 that have been made under a court order or written agreement are non-taxable in the hands of the recipient and non-deductible for the payer. They still need to be reported on the return, and that's as of May 1997. As well, just to give you the short version, any agreement that has been altered since May 1997 generally has shifted to this new rule. So the only cases where child support would be taxable deductible would be for an agreement that predates May 1997 that has never been altered. There's more details in the ink doc if you're interested. As a practical matter, the baby born in April 1997 would now be 28. Very few babies very few 28-year-olds are still going to be getting child support payments. Um, there are child support agreements where someone agrees to pay child support until the child grows up and goes to college, graduates college, things like that. So never say never. However, this is vanishingly rare. It's, however, important to be familiar with the rules for taxable deductible support payments because these still apply to spousal support. Now, for support payments to be taxable deductible, then, they need to meet these requirements. So the amounts have to be paid under the terms of a court order or written agreement, and they have to be for the maintenance or benefit of the spouse or common law partner or the taxpayer's children or both. And the recipient and payer need to be living apart at the time the payments are made. In other words, these are legally required payments. There's more points on the next slide. Okay. The payments also need to be of a fixed or predetermined amount, and they need to be regularly scheduled on a regular or periodic basis. So it cannot simply be send me whatever money you can whenever you can. As well, the recipient has to be able to spend the money at their discretion. So simply paying someone's rent for them or paying their utility bills that would not qualify as a support payment. The payments need to be made directly to the taxpayer's former spouse or common law partner, or to the parent of the taxpayer's child. So payments to a third party won't qualify. Payments to the child won't qualify. They have to go to the spouse or parent of the taxpayer's child. All right. Now, just a few clarifying points. Oh, and the last point here, all required non-taxable, non-deductible support payments have been made. I'll explain that in a moment. So, first, just to make clear, under these rules, you can see that if someone is making payments in arrears to a government agency, which the government agency then passes on to the former spouse or parent, those would be typically considered a support payment. But if someone is instead paying penalties to a government agency or things like that, those would not be considered a support payment. Now, taxable deductible support payments, again, to be clear, we are talking the vast majority of time about spousal support payments. There is a very small possibility that these might be referring to child support payments if they're from very old agreements. Or you might be doing a tax return, which is from 2016 or something. So it's within the realm of possibility you might encounter this for a child support payment. So do be aware that it used to apply to child support as well. Now, this final point then, what it means is that if someone does not pay the entire amount of required support in a year, whatever they do pay is considered to go to child support first. Right? All required non-taxable, non-deductible support payments need to be made before you consider anything to be taxable or deductible. All right, so that will come into play if someone doesn't pay the full amount of their payments in a year. We're going to go through all of these in a little bit more detail as we go through, just to explain a bit more, but this is kind of the overview. Now, the requirement for a court order or written agreement makes something a support payment for tax purposes, but payments that are made before the date of the court order or written agreement still qualify as support payments if they were made in the year of the agreement or the immediately preceding year. And the document specifically says prior payments are considered to have been made under this agreement. So if someone is making these payments for 5 years and then they write an agreement, they're not going to be able to claim the first 3 years of them as support payments, only the year of the agreement and the preceding year. The amount of the payments needs to be fixed in the agreement, and they need to be periodic. If someone is paying several payments at once to catch up with things, so for example, they don't make all the payments in a given year, and then next year they make a large payment to catch up, that is considered to have been made on a periodic basis if it's just on a catch-up basis. However, if they are instead just giving a large sum of money in order to get out of the agreement and get released from future liability, that is not in accordance with the original agreement, and therefore it's not going to be considered a support payment. Now, if payments are made to a third party, then, based on what we have seen before, they will qualify if the agreement specifies that these payments are taxable deductible, or the ex-spouse is allowed to redirect the payments for their own use. So therefore, payments to provincial maintenance enforcement programs will generally maintain their taxable deductible status. However, payments made to something like a landlord or a utility company would not qualify unless these were specified as taxable payable in the agreement. Now, for child support versus spousal support, again, no amount can be deducted for spousal support. No amount can be included in income until all of the child support payable for the entire year, and if there's more than 1 year involved, up to the present time, all child support payable under the agreement or court order has been paid. Spousal support must also be registered with the CRA before it can be treated as deductible taxable. So again, the agreement can be sent to the CRA, but if spousal support is in the agreement and wants to be treated as deductible taxable, Form T1158 needs to be filed. Now, there's an example of this in the Inc. doc, which I think will be helpful to look at. That's illustration 12-3. Let's pull that up here. Oop, not that one. Yeah, illustration 12-3. And again, as always, there's more in the textbook than we have time to go through in class. I'm just hitting some of the highlights here, but I do encourage everyone to have a look at the textbook and look at some of the examples here. So here's an example of ordering support payments. So Harry, in this case, has to pay child support of $250 a month and spousal support of $250 a month to Nancy under a written agreement. And during 2024, he paid $500 a month from January through August. That's $400. And in late August, he lost his job, and thereafter paid only $100 a month for the rest of the year. So $400 for the rest of the year. So in this case, he cannot claim any deductible support payments until all of the required non-deductible support payments, child support, right? So all the child support is paid. So for the entire year. So the child support for the year is $3,000. That's 12 times 250. So of the $4,400 that Harry paid in the year, the first $3,000 is considered to be child support. The remaining $1,400 is what can be claimed as deductible support, as spousal support. So Harry reports $4,400 for his total support payments in the year on line 21999, but he can deduct only $1,400 on line 22000. Likewise, Nancy reports $4,400 on line 12799, but only includes $1,400 in taxable income on line 12800. If Harry gets fully caught up in the future, he will be able to claim the full deduction for the spousal support in arrears in the following year. So it doesn't go retroactively. In whatever year he pays it up, he'll be able to make that deduction. All right, now question I see. Oh, you're confused about whether an early payment will be treated as a support payment or not. Okay, that's a good question. Get back here. It stopped sharing for some reason. Okay, there we go. So an early payment is treated as a support payment if the written agreement specifies that it can be, right? But this only goes back 1 year. So if you're making early payments for years and then get a written agreement, it cannot be done retroactively further back than 1 year, okay? And as well, the document specifically needs to say that prior payments are considered to have been made under the agreement. Okay, Mohammed? Good. Right. Now, another implication of support payments is, and we talked about this previously when we were talking about the amount for eligible dependent, but it's good to bring it out again. As a general rule, a taxpayer cannot claim a personal amount in respect of any person for whom they are required to make support payments. If you are making support payments, you are by definition not the person supporting them in the regular sense. You are legally required to make support payments for them. So if you are making support payments for an ex-spouse, this would not allow you to claim the spousal amount for them, say, or the Canada caregiver amount, say. But there are exceptions in the year of separation reconciliation. So in a year where for part of the year you are a spouse and part of the year not, there is an exception in that case. Now, in cases where both parents are required to pay support payments in the same year for the same child, as sometimes happens in certain custody arrangements, or if a child is going from the custody of one parent to the custody of another parent, then there's a special exemption which allows one parent to claim the child. Right. Now, this all corresponds to the corresponding entries in the checklist for the amount for eligible dependent. So if you go back and look at 7D, note 3 there, it's the same information there. Basically, the idea is that someone should always be able to claim the amount for eligible dependent for a given child, and simply because both parents are paying support payments, that technicality is not going to prevent that. The parents do still need help. Now, another implication of all this is for legal fees relating to custody and support payments. Remember the general rule that legal fees need to be related to income in some way. So they can be claimed on line 22100 if they were paid to collect late support payments, establish the amount of support payments, or obtain an increase in support payments. Legal fees that have been paid to make child support payments non-taxable, that is, to shift them from an old-style pre-1997 agreement to the modern rules, these can also be claimed, but they are claimed on line 23200. Legal fees for other purposes relating to custody cannot be claimed. So you cannot claim legal fees for obtaining a divorce or drawing up a separation agreement unless it has provision for support payments. You cannot claim legal fees relating to obtaining custody or visitation rights. Any lawyer's bill should provide a breakdown of what the fees were for. And as well, legal fees incurred by the person required to make the support payments are not deductible. And that makes sense if we remember that the government does not want to incentivize the person with the higher income running up the legal fees and taking things to court. So the government wants to discourage that. They want to help the person receiving the support payments more, because that is generally the person who needs the help more. So that is the reason behind that. They don't want to incentivize someone making things difficult. Right, so let's look at examples. And then let's look at our time here. We're coming up on 7 o'clock, so our time's pretty good. We'll let you guys decide if you want to have a break in a few minutes or push through to 7:30. Right, let's look at some examples to see how we've got this. All right, so first, Lou and Lise have been separated for 10 years, and they have a 15-year-old child, LJ. LJ has lived with Lise since the separation, and per court order, Lou has paid $500 per month in child support since 2018. So, true or false? Neither Lou nor Lise need to report anything on their tax returns, since it is child support, and therefore it is not taxable deductible. Is this true or false, based on what we've learned so far? It's right. It is. Oh, no, it is false in this case. So you're right that it's false. Remember, they still need to report the total support payments made and received, even if they're not taxable deductible. So they're reported for information purposes on lines 12799 and 21999, right? So they are still reported. They're just not included in income or deducted from income. And this makes sense if we understand that the CRA has a copy of the support agreement on file with them. So this information, the CRA wants to have this information so that it knows that the agreement is being adhered to. All right, let's try another example. Carl and Claire have been separated for 8 years. They have an 11-year-old child, CJ. CJ has lived with Claire since the separation. Per a court order, Carl paid $400 a month in spousal support and $600 per month in child support in 2024. Carl has never missed a payment. So, what amount can Carl deduct from his income? So it's 400 per month times 12. So that would be 400 times 12, 4,800. Excellent. All right. Now let's give you a tricky one. Dan and Dawn have been separated for 6 years. They have a 12-year-old child, DJ. DJ has lived with Dawn since the separation. Per a court order, Dan was required to pay $400 per month in spousal support and $600 per month in child support in 2024. Jack paid all payments from January to October, but unfortunately missed the November and December payments. All right, so our question here is, what amount can Dan deduct from his income? Very good, guys. So for anyone having trouble, what we do in cases like this, we look at the actual amount paid in the year. So in this case, 400 plus 600 is 1,000 per month, and it was paid from January to October. So that's 10 times 1,000 is 10,000 actually paid. Oh, I accidentally sent that just to Jason. That's for everybody, Jason. I think you got it, Jason. I'm not singling you out. There you go. All right, there you go. All right, so 10,000 actually paid, right? And then we need to look at the child support required for the year. So for the year is $600 times 12 equals 7,200 child support. So 7,200 child support required for the year. Exactly. So $10,000 minus the 7,200 equals 2,800. And that 2,800, by definition, whatever is not child support is spousal support, right? And it is the spousal support which can be deducted from his income. All right. Okay, so on that note, guys, it is 2,800. There we go. All right, so it is just after 7 o'clock. We could take a short break now if you guys would like, and take another break, a short break before we get onto the chapter review problems. How do you feel? Do you want to push through to 7:30? Mohammed, you would like a short break? Uh, hmm. I think people, but yes, but I want you all to be happy and satisfied. Okay, maybe a short break, and then we'll take a longer break uh, later on. Then, but first, let me answer this question here. So, Grant is asking, does he put 10,000 on 27999 and 2800 on line 12800? Okay, so let's just go back a moment. So, so 10,000 is what he actually paid in the year. So that is what he would put on 27999, and only the 2800 would go on line 12820. 12800. That's correct. All right, good stuff. Okay, let's take a short break then. It is about 7:05. So let's take a little break till 7:10. And that way you can stretch your legs, get a glass of water, whatever you like, and then we'll resume shortly. Doreen, let's just pause it here, and then we'll pick up around 7:10. Thanks, Doreen. All right, we are back. So let's see. Let's give you a poll question. So this is a little check to see you had a chance to read the chapter, or if not, make an educated guess. And it is about adoption expenses. So it's a simple question, and if you've had a chance to read the chapter, or you remember your T1 form, it should be relatively simple. Adoption expenses, are they a deduction, a non-refundable tax credit, or a refundable tax credit? Please take your best shot. Five more seconds. There we go. And WebEx is just going to tabulate the results for anyone who has the window open but hasn't hit submit just yet. But I'm pleased to see that most of you got the correct answer. And the correct answer is, as Gurjinder points out, it's on line 31300. It is a non-refundable tax credit. And I think we can remember this. It kind of makes sense. Deductions usually have more to do with income, whereas adoption expenses have more to do with they're not a personal amount in and of themselves, but things like medical expenses, education expenses, things to do with people tend to be non-refundable tax credits. So, and no exception to that general pattern here. Adoption expenses are a non-refundable tax credit. They are claimed on line 31300 in step 5, part B. It is a maximum amount of $19,066 per child. This is indexed for inflation per year. So, for example, in 2023, the claim was maximum was $18,210. It is indexed for inflation per year. And what's unusual about adoption expenses is that the claim can only be made in the year the adoption is finalized. And eligible expenses incurred during the adoption period, which may last several years, can be claimed, but only in that final year to the limit in the final year. The claim can be split between the adoptive parents, but the claim cannot exceed the $19,066 per child limit. Now, some provinces may also offer a provincial adoption credit. When we do Chapter 14, I'll touch on that for British Columbia. In most cases, the provincial amount will vary from the federal amount, but we will touch on that briefly when we talk about Chapter 14. Our example in the textbook will show you part of this. This is illustration 12-4. So Nick and his common law partner Heller started the process of adopting a child from Bosnia in 2022. The adoption was finalized in 2024. Nick's net income for 2024 is $47,000. Heller's net income for 2024 is $7,000. And their eligible adoption expenses by year were $55.47 in 2022, $64.79 in 2023, and $9,472 in 2024. So, who should claim the expenses and how much should they claim? So Nick should claim, and he's going to be claiming expenses from all 3 years. How much can he claim? Remember, Mohammed, Heller's net income is less than Heller's basic personal amount, and adoption expenses are a non-refundable tax credit. So if Heller were to claim them, it would not benefit him. Right. The maximum is $19,066. Now, in this case, the expenses for all 3 years are more than that amount, but you can only claim $19,066. Again, that limit is indexed for inflation and is different from year to year, so you'll want to be careful that you're using the correct limit for the given year. As a practical matter, adoption expenses are relatively uncommon. You don't see them every day, but they are common enough that it's important to be familiar with the rules. Right. Now, in contrast with adoption expenses, child care expenses are a deduction. They are calculated on Form T778, and then they are deducted on line 21400. Now, there are quite a few rules around child care expenses, which we will get into, but the most obvious is that they have to be incurred on behalf of a child who requires child care. So they have to be incurred on behalf of a dependent child whose income is less than $15,705. That is, they are making less than the basic personal amount. Unless they are infirm, the child also has to be under 16 at some time during the year. So an infirm or disabled child, you could claim child care expenses up until they're 18. As well, the taxpayer must have resided with the child at the time the expenses were incurred. So obviously, the child care expenses are incurred so that the person residing with the child can go do something else, right? If the person is living in a different place than the child, then why would this person need to be paying child care expenses so that the person could do something else? Now, just before we go on, in general, we're talking about income here. Whenever we're talking about income in this next section, the term is going to be net income unless otherwise specified. So when we're talking about lower income spouse or common law partner versus higher income spouse or common law partner, we're always referring to net income. Now, what is the something else that a person needs to leave the house that they require childcare for? Can you claim childcare expenses so that you can go on a vacation and leave your child at home? Work is correct. But a little bit more expansive than that, Beanish, right? Remember the general principle in tax that things that can be deducted, generally speaking, have to relate to income in some way. So, childcare expenses, therefore, have to be incurred to allow a taxpayer to either work, either as an employee or self-employed, so business income, say, or to conduct research or similar work that they're getting a grant for. So this is very similar to work. It's just not technically employment income, or to attend school. And of course, the purpose of school is to gain an education so that you can work. So this makes sense. So childcare, which is not for one of these purposes, is not claimable. So you cannot simply claim childcare because you want to, go have a night at the opera or something like that. Now, notice that school does include high school here specifically. In our next session, we're going to be talking about post-secondary students, and we're going to be talking a lot about university students. So it's very easy when we talk about students in school to just kind of mentally think that we only include that, but no, it does also include high school if someone has to go to high school. Now, childcare expenses here, just a note that uh, this also can include the cost of maintaining a babysitter or a place in a day nursery while the taxpayer is on maternity or paternity leave. That's not always thought of as childcare expenses, but yes, that kind of reservation fee can be claimed, providing that the person is intending to return to work with the same employer. Taking this course, well, yes, this course does count as attending school, but it's not full time. But yes, you will all be getting a tuition form for this course that you are taking, not to worry, but we'll talk more about that next time, I think, in the implications of a tuition form. But yes, this would be an example of attending school. So if you have childcare so that you can take this course, yes, that would be claimable. Now, eligible childcare expenses are a bit restricted in what you can claim. In addition to the reservation type fees we discussed previously, they include, generally it needs to be uh, uh, on a professional or business basis. So eligible childcare expenses include things like babysitting services, daycare centers, pre-kindergarten, other educational institutions if the receipt identifies the amount as being for childcare. So if you're paying for someone to go to school, your child to go to school, the education portion of it can't be claimable, but any after-school care, say, would be. Often after-school care is conducted at a school, on school grounds, things like that. So the child care portion can be claimed. Advertising or placement agency fees can also qualify, as well as day camps or day sports schools where childcare is the primary goal. So not necessarily, a Vancouver Whitecaps training camp or something like that, but if it's some sort of youth soccer thing, which is only for a couple hours during the day, and it's more about childcare than becoming the next World Cup athlete, then that would usually be claimable, although there is a bit of a limit which is placed on overnight sports camps and boarding schools, as we will see. And this is to prevent uh, exploiting the system and taxpayers writing off the entire cost of boarding school. So boarding schools or overnight camps are limited to a certain amount per week, which works out to there's a maximum per year per child that you can claim, and so the maximum per week is simply 1 week's worth of the yearly maximum. So for children who are disabled, the maximum is 275. Hold on, Mohammed. Yeah. So For children who are disabled, the maximum is $275 a week. For children under 7 who are not disabled, it's $200 per week. And for every other eligible child, it's $125 per week. Now, Mohammed, you're wondering if I can elaborate advertising or placement agency fees. So this is if you're hiring a babysitter and you need to advertise to hire a babysitter, or you need to get fees from a placement agency. That's more for people who hire live-in nannies and au pairs and things like that. They go to a reputable agency to hire a professional nanny or things like that. So those kind of miscellaneous fees would be claimable. Now, when you are claiming your childcare expenses, receipts are very important. Childcare expenses have to go to, however, a non-arm's length person. So childcare expenses can be paid to any resident of Canada other than the father or mother or a supporting person, a child or brother or sister if they are under 18, or someone for whom the taxpayer or another supporting person is claiming a personal amount. So, for example, if your mother-in-law is living with you, and you are claiming your mother-in-law as an eligible dependent, then you cannot claim child care expenses that you pay your mother-in-law. Would be an example there. So basically, it needs to be someone who's not in your immediate circle. Now, it does mean the under 18 rule, though, does mean that if you're paying your 19-year-old adult child to take care of a younger sibling, then that could be claimed as a child care expense. However, the expectation is that anyone that you are claiming child care expenses for, that person is reporting that amount as income on their tax return. So if you are paying your 19-year-old to look after a younger sibling, that can be claimed. But if you're paying your 16-year-old to look after a younger sibling, that cannot be claimed. And by the way, the youngest, my latest understanding in British Columbia, the youngest someone can be where they can be responsible for younger children is 15. Now, the CRA does regularly ask to see child care receipts. And so for individuals, there should be a social insurance number on the receipt, and their social insurance number should be entered on your T778. This is, of course, isn't a concern for daycares and similar organizations where it's not an individual. Now, for claiming the child care expenses, the tricky part, the part which often trips up people, if there is more than one supporting person, the expenses must usually be claimed by the one with the lower net income. Now, the purpose of this rule is to prevent abuse of the system, so that you don't have, say, a wealthy taxpayer, your millionaire tycoon type who is writing off child care expenses, while their spouse, who is earning much less, is staying at home, not looking after the children. So for this reason, the understanding is that the person with the lower net income would normally be looking after the children because someone has to. But in order for them to go work or go to school, they have to spend money on childcare. Now, a supporting person, aside from the taxpayer, is typically a spouse, but it is another person who resided with the taxpayer at any time during the year and at any time within the first 60 days of the following year, is also a parent of the child, or the taxpayer's spouse or common law partner, or, if neither of those apply, an individual who claimed a personal amount for the child. So this kind of covers all the bases there. Basically, someone who's a parent of the child, the spouse of the taxpayer, or someone who is acting in those capacities. Now again, this all makes sense that the lower income taxpayer has to do it if we remember the expenses, these deductions are related to a person's ability to earn income. And we need a clear rule to make this determination of who can make the claim, and without that rule, the system could be abused. However, there are some important exceptions to this rule. So What if the lower income person cannot provide the care? So the person with the higher net income can therefore claim expenses incurred during any period when the lower income person was attending school, either part-time or full-time, or they were temporarily infirm and confined to a bed or wheelchair, hospital, or similar institution for at least 2 weeks. That is, they weren't mobile either due to an injury or illness, but this was not a full long-term disability or infirmity, or they have a long-term disability or infirmity. So they are incapable of caring for children during the entire year because of mental or physical infirmity, or they were in prison for at least 2 weeks, or they were separated for a period of at least 90 days, including December 31st, but reconciled within the first 60 days of the following year. So this would be a not quite separation, in other words, but they were for a period of time uh, at the end of the year, a separation type of a temporary separation was going on, so they were not there to care for the child. All right, so all of these exceptions are enumerated on the T778 form, which we will look at shortly. So receipts, as mentioned, if these are paid to the individual, the receipt has to include the social insurance number. The expectation is that individual will be reporting this income on their tax return. So communication is key here. If you are expecting to deduct something on the tax return, the person you are paying should understand that. Receipts are not sent with the tax return, but they do need to be kept in case the CRA requests them, which they often do. So for the form, it is divided into 4 parts. The first couple pages are instructions, which are aimed at somebody who hasn't taken this course, say. In part A, we total up we list the children involved and we total up the child care expenses for the year. And in part B, we calculate the basic limit for child care expenses. What is the limit to the child expenses which could be claimed? As you can imagine, child care expenses could potentially be quite high, so there is a limit to how much you can claim. In part C, you simply fill it out to indicate if you are the person with the higher income. And if you are the person with the higher income, but you are able to claim some of the expenses due to one of the conditions that were mentioned, that's what's handled in part C. Part D is used if you were enrolled in an educational program in 2024. We're going to deal with each of these in turn. All right. So the total child care expenses then are done in part A. So the first name, the last name, and the date of birth for each eligible child are listed here. And it's important to note you list all of the eligible children, even if you did not pay child care expenses for each of them. And that is because the limit of child care expenses you can claim is based on your total number of children and their limits. Right? Then in the second section, you list the name of each eligible child, whom the payments were made for, and list any child care expenses that were paid. So here we have the name of the child care organization or the name and social insurance number of the individual receiving the payments. And if it's for a boarding school or overnight camp, the days or weeks are listed. The weeks are listed here. Now, there's a maximum amount, again, you can claim for expenses for boarding schools, overnight camps. As mentioned, it is $275 a week for a disabled child, $200 per week for a non-disabled child, age 7 and under, and $125 a week for any other child 16 and younger. $200 for a child 6 and younger. And for information purposes here, you also enter the amount of expenses above that were for a child 6 years of age or younger and living with you when the expenses were incurred. Now, here is where we calculate the basic limit for child care expense. So for each child for whom the disability amount cannot be claimed, but they were born in 2018 or later, it is $8,000 per year per child. For children for whom the disability amount can be claimed, it is $11,000 per year per child. And for children born 2008 to 2017, and for children born in 2007 or earlier with an impairment in physical and mental function for whom the disability amount cannot be claimed for, so in other words, an infirm child, then it is $5,000 per child. Now, 2007 to 2024, yes, so that would be 17. So your 17, 18-year-olds, say, would qualify here. All right. And again, notice it is per child for a year. Then this is all totaled up on line 4, and that is this is the total of the limit based on the children and their ages. Then here, line 5, we enter the childcare expenses calculated in part A. In line 6 is your earned income, 2/3 of your earned income. So the limit for childcare expenses is either the amount from line 4, that is based on the total children and an allowance per child, line 5, the actual expenses, or 6, 2/3 of your earned income. Whichever amount is the lowest is what is claimable here. So notice if your earned income is 0, then the amount you can claim is also 0. Now, if you are the person with the higher net income, then you're going to continue at part C and leave 9s, 8, and 9 blank. Presumably, someone with the higher net income, this amount would not be 0. But if you're not the person with a higher income, then you deduct anything that the person with the higher net income claimed, and so line 7 minus line 8 is your allowable deduction for the year. All right, question here. And Valerie asks, if you have a sitter for all the kids, do you just divide the amount per child in this section? No. In this section, in part B, this is the maximum per year. So this is totaled based on all of your children. It is completely independent of what you paid for the children. So let's say in the first section you only paid child care expenses for one child, right? You would still include the other children here in part B. If you paid a sitter for 3 children, and the sitter, let's say the sitter just charged you $300 to look after 3 children, then you would list all 3 children above, and then you would divide it per child. If that's the thrust of your question, then yes, you would list all the children who are cared for, and if necessary, divide the child care expenses appropriately. All right. And I feel there was another question here. And Gajinder is asking, do you calculate the age based on the current year or 2024? So this is the form for 2024. Notice that it doesn't ask you to list the age of the child. It is simply the question is, were they born in 2018 or later, and you're claiming the disability amount, or not, right? So if you can claim the disability amount and they were born in 2024 or earlier, right? So it simply asks, it's never based on their age, it's based on what year they were born, which nicely takes the ambiguity out of it. Okay. And in part C, then, this is for the person with the higher net income. So notice how it lists all the various exceptions. So you fill out this part and tick the applicable boxes if someone was in any of the situations below. So A is if someone was in a part-time educational program, B, a full-time educational program, C, the other person was temporarily impaired. You need a statement from the attending physician. D, the person was impaired for an indefinite period, that is long-term. Again, attach a statement from the attending physician. E, the person was in prison or somewhere similar. Or F, you and your common law spouse partner were due to a breakdown in the relationship, living separate and apart. So here you list the name of the person with the lower net income and their social insurance number and their net income here. And here, line 4, you multiply by 2.5%. Right. So from line 4, just to go back, quick, go back, I said. So line 4 then is this total of the expenses per year. Now that 2.5%, you might wonder where that comes from. Well, if you were to take, say, 5,000 and divide it by 2.5%, you would wind up with $125 per week, right? So it's taking that previous maximum and figuring out what is the maximum per week. And then you multiply this number, that is the weekly maximum, in other words, and you multiply that by the number of weeks that conditions B through F applied, plus the number of months that someone was in a part-time educational program. So that total then is the maximum amount that the person with the higher net income can claim, and so you will enter whatever is less, that total or the expenses from line 7. Now, only the person with the higher net income fills out Part C. Part D is for situations where either you were the only person supporting the eligible child, and line 7 equals line 6, and you were in an educational program, and if you are the person with the higher net income, line 7 equals line 6, and at the same time, in 2024, you and the other person were enrolled in an educational program. Now, this part here does not apply to the person with the lower net income because the other person claims this part of the deduction for both of you. So in this case, again, we take the amount from line 4, multiply by 2.5% to get the maximum weekly amount. And then this amount is multiplied by the number of weeks in a full-time educational program and by the number of months in a part-time program, unless it includes a week that's already been included, where either you were enrolled in part-time educational program and there was no other person, or you and the other person were enrolled in a full-time or part-time educational program during the same months. Notice here a different maximum applies. Your net income here, so not including the child care deduction, right? 2/3 of your net income is the limit. So therefore, if you are supporting a child and or you're by yourself or you're the person with the higher net income, in this case, it is not required for you to have earned income, right? Remember in Part B, you have to have earned income. The purpose of the child care is to allow you to work. If you're in school, it can simply be applied to your net income instead. That's the intention there. All right. So any questions on all that? Got a general sense of it? I think it'll be clearer once we work through an example or two in our chapter review problems, so we will get there. So let's therefore stretch a bit and look at some questions. So for childcare expenses, our chat window up here. Look where that chat window goes. There it is. Right. So So first, Bill and Karen are divorced and the parents of one child who is in Bill's custody. In order to work, Bill pays Karen to care for the child. Assuming that Karen did not reside with Bill, can Bill claim a deduction for the child care expenses he incurred? No, that's right. Right? Karen is a parent of the eligible child. Right? She's not an arm's length person. Very good. Let's try another one. Mandy is a single parent who works most nights. Because of this, she pays her neighbor for letting her 15-year-old son spend the night and for feeding him dinner and breakfast. Can Mandy claim this expenditure as a deduction for child care purposes? Yes or no? Good. Her son is under age 16, so he would still qualify as a child, so this would be child care expenses. All right. Jake and Anne are common law partners. Caleb is Anne's 3-year-old child from a previous relationship. Jake paid a daycare $6,000 during the year so that he and Anne could go to work. Can Jake claim the deduction for child care expenses? There you go, Valerie. So potentially, yes, but we have to determine who has the lower income, right? Who is the lower income common law partner? Potentially, either of them could make the claim. Now, it is sometimes the case that the partners have very similar income, so it can be different from year to year and can depend on relatively narrow factors within the return. But still, either one or the other will be the lower income spouse. So in this case, potentially, but we need to know more information. Number four, Mary, who's a single parent, paid her 19-year-old sister Michelle to look after her 2-year-old daughter so that she could work. Can Mary deduct the childcare expenses she incurred? Good. So in this case, the answer is yes, because Michelle is over 18. Note that Michelle must also declare this income on her tax return. Right, and I think I might have missed a question there. Let me just scroll back up. Right. Karina is wondering if it's beneficial for the higher income spouse to make the claim. Usually, it will be beneficial to make the claim. Absolutely. All right. Now here's one. Joan is a single parent whose only income is from EI. In order to upgrade her skills, she went back to school full time. And while she was in school, she paid her neighbor to look after her 2-year-old son. Are these child care expenses deductible? Good. The answer here is yes. But note, so first, child care expenses that are incurred in order to go to school are deductible. And even though her income is entirely from EI, it's not earned income, she can still make a claim because the child care claim when attended school is limited by 2/3 of net income rather than earned income. The deduction is also limited to $200 per week that she was in school. And remember, that's 2.5% of $8,000, up to a total of $8,000, which is the per child limit, or whatever she spent, whichever is less. All right, good stuff. Let's give you something a little more interactive. Here's a poll question. There we go. So, I think this one shouldn't be too hard. if you've been paying attention. This is more just to make sure people are awake. So, for married or common law partners, then, childcare expenses are claimed by A, the lower income spouse all the time, B, the higher income spouse all the time, C, in most cases, the lower income spouse, but in some cases they can be claimed by the higher income spouse, or D, either taxpayer. They can decide. All right, let you have some fun with that. All right, I can see most of you are clustered around the correct answer. Very good, very good. Not to worry, Mohammed, not to worry. All right, good stuff. So, WebEx is just tabulating those results. Good, very good. And let's share that. All right, so most of you got the correct answer. So again, the correct answer here is C. So in most cases, they have to be claimed by the lower income spouse, but remember there are exceptions. So in some cases, they can be claimed by the higher income spouse, or at least partially claimed by the higher income spouse, generally speaking, because the lower income spouse was unable to provide childcare for one of those listed circumstances. And all of those are listed on the T778 itself, if you have trouble remembering. All right, so we're just going to press on a few more slides, and then we will take our second break. And after the break, we will spend the rest of our time for the chapter review problems. So, skip the slide there. All right, so now when there is a change of marital status, this will have an effect on personal amounts. So for the amount for an eligible dependent in the year of marriage or the start of a common law relationship, if one spouse or common law partner supported a dependent prior to the change date, that person can claim the amount for eligible dependent. It is also possible in some circumstances for a taxpayer to, no, I've skipped a slide, sorry. There we go. All right, right. Let's do this one first. It'll make more sense if we do this one first. Okay, right, sorry. All right, so in the year of marriage or the start of a common law relationship, then for the spouse or common law partner amount, the spouse or common law partner's net income for the entire year is used to calculate the spouse or common law partner amount. However, in the year of separation, the spouse or common law partner's net income prior to the separation date is used to calculate the spouse or common law partner amount. You cannot claim both the support payments made and the spouse or common law partner amount. So in the year of separation, then, you may have the option to claim support payments or the spouse or common law partner amount, so you have to decide which one to claim. Typically, one will be more beneficial than the other. In any subsequent year, of course, you are no longer a spouse or common law partner of the person at all, so only the spousal support payments can be claimed, unless it is a year of reconciliation. I think after the break, I will show you some examples from the textbook, just to help illustrate some of these. The amount for eligible dependent, similar considerations apply. So if one spouse or common law partner supported a dependent prior to the change date, they can claim the amount for eligible dependent. It is also possible for one taxpayer to claim a spouse or common law partner amount and another taxpayer to claim an amount for eligible dependent in respect of the same dependent. So for example, if let's say in a given year I'm looking after my father as an eligible dependent, and my father, being a widower, goes and gets married and moves in with some rich millionaire lady later in the year. Then she could claim him as a spousal dependent. In other words, two different people claiming an amount for the same person. This is possible, but they have to be two different people, and it has to be in the year of a status change only. It is never possible for a taxpayer to claim both the amount for a spouse or common law partner and the amount for an eligible dependent, which makes sense. The amount for an eligible dependent is equivalent to the spouse or common law partner amount, and it is aimed at single taxpayers. So claiming both of them would mean functionally that you were not functioning as a single taxpayer. All right. Okay, now for the key point with the amount for eligible dependent is it's only required that the person claiming that be single or equivalent to single for part of the year, not for the entire year. So therefore, if you're supporting a qualified dependent during the part of the year where you are single, the claim's usually going to be allowed. Again, we'll look at some examples after the break. In the year of separation, a short period of separation can sometimes allow a claim for amount for an eligible dependent, as we touched on previously when we talked about dependents. But the key thing is one spouse or partner cannot be supporting the other during that period of separation, unless by the terms of a written agreement or separation, in which case there are legally defined as support payments, right? Only in the year of status change is it possible to claim an amount for an eligible dependent when deductible support is being paid. And again, in this case, you have to choose between the support deduction and the credit. Remember, for a short period of separation in the year, the CRA can also just require proof that the couple was living separately. All right, 3 more slides and then we'll take our break. So, our last break. So, if there is a marital status change, it's important to remember that this can affect your refundable credits. So for GST credits and the Canada Child Benefit, the CRA needs to be informed as soon as possible of a marital status change. Note that a separation needs to last at least 90 days before the RC65 can be sent in, because you don't want to send that in and then whoops, it wound up not being a separation after all. Once the CRA is informed, then the GST credit, the Canada Child Benefit, and any corresponding provincial benefits will be recalculated accordingly. It's very important to do this because if you wait until tax time and say your family net income has risen as a result of getting married, say, then you will be required to repay any benefits that you were not entitled to. If you want more information about the various child benefit related programs, provincial, territorial programs by province, that is in the federal guide T4114, which we mentioned in the textbook, and that has more in-depth information if you want to look at a specific province. In general, though, most provinces have some sort of matching child benefit that is sent out together with the federal CCB. Now, in the case of shared custody, this is what applies when a child lives with each parent in separate locations on an equal or nearly equal basis. In this case, there's a special calculation for CCB and GST, HST credits for shared custody, where each parent receives 1/2 of the benefits they would have received if they were the only parent. So these calculations are completely independent. They are only based on the individual parent's income. And it's entirely possible that one parent's income may be too high to receive GST, HST credit, or the Canada Child Benefit, and in that case, the other parent will still only receive half of what they would have received in a full custody situation. Now, note that in these cases, it's usually necessary to inform the CRA of the situation and or provide documentation such as agreement signed by both parents. Some parents, in some cases, decide simply to let one parent claim everything and not let the CRA know about what's going on. But as we've seen, this is one of the reasons why support agreements need to be registered with the CRA. If you don't want the CRA to be tracking all of that, then you don't register them and don't claim them on the taxes. And it's considered to be more of an informal arrangement. All right, one last thing before our final break. Let's have another poll question. Just again to see how well you absorbed all that. So, in the year of a marital status change, a taxpayer can choose to claim the spousal amount or support payments, whichever is more advantageous. Right, true or false? All right, WebEx is just tabulating the results. It looks like most of you had the correct answer. All right, so the correct answer is true, right? You can only choose one, but it is your option which to choose. You can choose whichever is more advantageous. Right, after our break, I will show you some examples in the textbook, and then we will get into our chapter review problems. So, but for now, let's take a break. It is 8:02, so let's get back at it. And most of the rest of the class are going to be working on the chapter review problems. But, as I said, first I'm going to look at the illustrations that I mentioned for some of the scenarios that we were looking at. So there's several examples in the textbook which are very helpful for illustrating some of the points that we've just been dealing with. So, and again, there's much more in the textbook than we're going to have time to look at here, but let's look at some examples of what happens when there's a marital status change in the year. So for personal amounts here, for example, slow, there we go. So here's one example to have a look at. So Ken and Jolene get married on June 10th, and Jolene received $8,600 of social assistance payments prior to the marriage, and this was her only income for the year. Ken had $42,000 of employment income in the year. So in this case, remember, in the year of marriage, someone's entire income for the year is factored into the spousal amount. But in this case, Ken can claim a $7,105 spouse or common law partner amount for Jolene because her net income is $8,600. But note, because it's social assistance, if they'd been living together throughout the entire year, the full amount of the social assistance would be included in Ken's income, and then Ken could claim the full spouse or common law partner amount because Jolene's income would be zero. Right, so in the year of marriage or common law partnership, the entire income is factored in, but in the year of separation, it's only the income up until the date of change. So Peter and Molly are married and have 3 children, but separated permanently on June 30th, after which Peter received $800 per month in social assistance for himself, or $4,800 for the year. So in this case, Peter must report all the social assistance he received, even though Molly had the higher income for the year, because they were not living together at the time Peter received the payments. Because Peter had no income prior to his separation, Molly can therefore claim the full spouse or common law partner amount on his behalf. Now, again, as we already said, in the year of separation, taxpayers who claim a spouse or common law partner amount cannot deduct support payments. They can claim one or the other, but not both. So here's an example of how we might compare that. Here, Fred separated from Mary on October 1st and began paying her $300 per month in spousal support on that date. Mary's net income before the separation was $2,500. Fred's taxable income before deducting the spousal support is $60,000. So therefore, Fred is in the 20.5% federal bracket. So what we would do is we could compare the benefit from the spousal amount to the benefit from deducting the support payments. So here, his allowable spouse or common law partner amount is $15,705 minus $2,500, or $13,205. By contrast, his allowable deduction for the year for support payments is 3 months at $300 per month, or $900. So claiming the spouse or common law partner amount gives 15% of $13,205, or a federal tax savings of $1980.75, while claiming the support payments would result in federal tax savings of only $184.50. And again, that's 20.5% times 900. So you can see, in a case like this, you can look at which would be more beneficial to claim and claim the more beneficial one. And normally the answer will be pretty clear. All right, for status change and ineligible dependent, we're going to look at some various examples here, just to give you an idea of the sort of things which we could encounter. So in the year of marriage, Harrison, a widower with 2 small children and a net income of $45,000. In August, Harrison marries Mavis, who has a net income of $34,000. He cannot claim a spouse or common law partner amount for Mavis because her income is too high, but he can claim an amount for an eligible dependent for one of his children because he was unmarried for part of the year and the children lived with him during that time. So in this case, it's pretty clear. He would claim the amount for eligible dependent. Now, rarely, as we mentioned, sometimes the amount for eligible dependent and a spouse or common law partner amount could be claimed by different taxpayers for the same dependent. And this is allowed only if the dependent was not married or common law through the entire year. So it has to be in the year of change of marital status. So Jenny, under 18, has no income, lived at home with her widowed father until September when she married Andy. Jenny's father is entitled to claim the amount for an eligible dependent for her, and Andy is eligible to claim the spouse or common law partner amount for her. Both claims are allowed since Jenny was married for only part of the year. In no case can a taxpayer claim both the amount for eligible dependent and a spouse or common law partner amount for different dependents. So, for example, George and Martha get married during the year. George has sole custody of one child from his previous marriage. His income is $48,000. Martha is $2,000. George is entitled to claim the amount for an eligible dependent for his child, but he can only do so if he does not claim the spouse or common law partner amount from Martha. Normally, it would be more beneficial for him to claim the amount for eligible dependent, assuming the child has no income and the spouse has some income. But in a case, the unusual case where a child had more income than the spouse, then of course you could claim the spouse. Now, in a year of separation, remember, taxpayer only needs to be single for at some time of the year, so a short and informal period could qualify. So Fred and Angie are married and have two children. They separated on February 1st and reconcile on November 15th. So their status at the end of the year would still show as married, but they were separated for a period during the year. Angie, during that time, had custody of the children and supported both herself and the children during the period of separation. So, while they would enter married as their marital status on the tax return, because Angie was living alone for part of the year, she may be able to claim the amount for eligible dependent for one of the children. But if she does, she cannot claim the spousal amount for Fred. Now, again, in order to be able to claim this amount, they cannot support or be supported by the estranged partner during this period of separation, and it may be necessary to prove this, document this for the CRA, because the CRA would obviously have questions if someone's status at the end of the year is married, but they're claiming the amount for an eligible dependent. Again, support payments under a written agreement or court order would not constitute support in this context, although that would be an unusual situation indeed. So if Fred had supported Angie during the separation by continuing to pay the mortgage and household bills or sending her money for food or other necessities, then that would constitute regular support, and Angie would not be able to claim the amount for an eligible dependent. Remember, regardless of her marital status, the purpose behind the amount for eligible dependent is to support a taxpayer who is financially operating on a single income. Right. Now, in the year of separation, and the last example we want to look at is for required support payments. So Jimmy and Alice have been divorced for several years, and their son Roger lived with Alice until July when he moved in with his father. So under the terms of their separation agreement, Jimmy made child support payments to Alice every month until Roger moved in with him. So Jimmy cannot claim the amount for an eligible dependent for Roger, because if you're required to make support payments for a dependent, you cannot claim a personal amount for that dependent, except in the year of separation or reconciliation, not applicable here. However, if Alice is now required to make support payments for the remainder of the year, August to December, she also cannot claim the amount for an eligible dependent. But there is that special rule. If both parents are required to make support payments at some time in the year in respect of the same child, the application of the support payment rule will would normally deny the credit to both parents, so there is this special exemption. This rule does not apply if it is the only thing that would prevent anyone making the claim for an amount for eligible dependent for Roger. So in this case, as a tiebreaker by mutual consent, one parent may make the claim for the amount for an eligible dependent, but they have to decide who will make it. Next year, assuming the circumstances continue, Jimmy may be able to claim the amount for eligible dependent for Roger because he's no longer required to pay child support. Okay, so I thought it was worthwhile to look at those examples just to clarify things, because we were covering a lot of ground near the end there. Does anyone have any other questions before we get into the chapter review problems? And of course, bear in mind, some of these we will be looking at in the context of the chapter review problems, so we will have time to look at those. Right. If not, then, as promised, we will begin by looking at chapter review problem oh, hang on. Yes. You would like to see the shared custody slide? Yeah, we are going to look at 11-1, absolutely. The shared custody slide. Yeah, let me flip back a bit. There we go. So we can actually look at an example of this, but just to refresh everyone's memory, this is when the child lives with each parent in separate locations on an equal or nearly equal basis. So it's not just spending the occasional weekend with something, it's more of a 50-50 situation. So in this case, the CCP and the GST HST credit has a special calculation where each parent receives half of the benefits they would have received if they were the only parent. And any shared custody parent not receiving the benefits should file Form RC66. So I believe there's an example in the textbook. So let's have a look at that. Here we are. Oh no. Okay, it's just not an illustration. Just a simple one. We do have some illustrations for the effect of the change of marital status on GST or the Canada Child Benefit, but that's relatively straightforward. If your marital status changes, your family net income will change, and therefore your GST and/or Canada Child Benefit will need to be recalculated. Key thing with this shared custody arrangement here is that each parent will only receive the amount that is 50% of what they would normally receive. And if this means that one of the parents, their income is too high to receive anything, then that's unfortunate. But the intention is to allow both parents to be able to collect, say, Canada Child Benefits. All right, now let me pull up my notes here. Strangely elusive for some reason, considering that I put them aside for this very purpose. Okay, anyway, for 11-1, as always, there's a situation. We're going to get you to do some questions and then fill out some forms. So for 11-1, just to review everyone's memory, fresh your memory here. So for 11-1, so here it is for the Edmondsons, Joshua and Charlotte, who live at Western Road in your city. They've lived at their home since 1980 within a census metropolitan area. Both of them are Canadian citizens. Neither of them own any foreign property. Both of them would like to answer yes to the Elections Canada question. Now, Joshua is retired. He spends most of his time fiddling with his stamp collection, which has now become a full-time hobby. Last year, he spent $2,000 acquiring stamps to add to his collection. Since the stamps are an investment, assuming that Joshua is being serious about this, Joshua wants to deduct the cost of the stamps as an investment expense on his tax return. Joshua has been collecting a Social Security pension from the U.S. since 2011, and in 2024 he received $150 US a month, and the exchange rate for the year, the average exchange rate, was 1.3698. Joshua's other income is shown on the income slips reproduced with the problem. Now, Charlotte plays bingo every Thursday and won a total of $5,000 in the course of the year. Her only other income consists of old age security and the interest from the joint account at the Bank of Nova Scotia, to which she contributed roughly 1/5 of the amount, and her husband contributed the rest. On September 10th, Joshua paid their dentist, Dr. Feldman, $897.74 for regular dental visits, and also paid $452.97 to Braddock Optical on October 2nd for eyeglasses for himself. On November 15th, he spent $150 to join the health spa because his doctor told him he had to lose weight and get more exercise. He has official receipts for these expenses. The Edmondsons also donate every year, and they have receipts for the following charitable donations. which are all registered with the CRA. So Canadian Cancer Society, Canadian Heart and Stroke Foundation, United Appeal, the Canadian Red Cross, and Scouts Canada. Joshua paid $1,200 in income tax installments during the year. Charlotte is not liable for installment payments. Now, if you ever get this broken image URL, it just means you need to refresh the page. So typically, just refreshing it in your browser should do that. F5 will also do it. So for T-slips here, Joshua has his T4A with his pension income, so $14,850. Notice the tax taken off is 10%. And remember, when tax is taken off of pensions, EI, similar things like that, it tends to be taken off. Either no tax tends to be taken off, or only a limited amount is taken off because the government presumes that you are in a situation where you're on a fixed income or some other kind of financially restricted situation, and that you need more money up front. And so they will take less tax off up front with the assumption that you will settle up at tax time. Here we have Joshua's T4A OAS and T4AP. Notice no tax is taken off at source, about 15,000 combined benefits. His T4 RSP has 5461 in annuity payments in box 16. No tax. Notice no tax taken off here. Hit T5 from CIBC with 1469.50, and T5 with some dividends from Maple Leaf Oil. And then the T5 from the Bank of Nova Scotia for Joshua and Charlotte with 74.50 in interest income, and then the T4A OAS for Charlotte with 94.08.49. So we're going to be answering some questions and then looking at Schedule 9. Then we're going to complete their joint election to split pension income, which is a fairly important form to have a look at. So let's work through. Okay, first of all, not that one, this one. Yes, there we go. So in terms of questions then. So first, can Joshua deduct the $2,000 he spent on stamps as an investment expense? Yes or no? And why? Good, Grant. Good, Diane. You've got it. It's a capital expenditure. Now notice, just to be clear, the stamps themselves are an asset. It's a capital property. The hope is that he will turn around and sell the stamps at some point in the future for a profit. So they are an asset. It is exactly the same as buying a coin collection, which is exactly the same as buying a bar of gold, right? So they are not an expense. They are the asset itself, right? An expense would be something like if he bought tools or holders or binders or things like that for the stamps. Those types of expenses are what are called capital expenses, though, when they relate to an asset. So they're not an investment expense. It's not like paying a broker. Instead, these capital expenses are factored into the cost base of the asset when it's eventually sold. Right? So they can be claimed, but they are claimed in a different way, not as an investment expense. They cannot be directly deducted on the return. Now you're getting into some interesting points here. Now, Grant, if he borrowed $2,000 to buy the stamps, this would still not be an investment expense. It would be a capital expense. It's an expense to finance the property, just like investment that you get to buy a piece of land. If you buy a mortgage on a piece of land, that interest is not an investment expense. It is a capital expense and is factored into the eventual sale of the land. And Diane, you're correct. He thinks of it as a hobby, but in some sometimes the line between a hobby and a business or an investment is kind of thin. This is a little off topic, but I think it will help illustrate. Uh, the CRA's test is more, is there an expectation of eventual possible profit? So if someone, uh, think of it like this, if someone bought a, a bar of gold with the idea of eventually selling it, then, it wouldn't matter whether they bought it for fun or as a serious investment. If they eventually sold it for more money than they paid for it, then that would be a capital gain. Um, on the other hand, some things where people try to claim them as businesses, the CRA will disallow because they'll say, no, this is obviously something where no reasonable person could expect to ever make a profit on this. The CRA is not in the business of subsidizing hobbies. So, but in this case, the stamps could potentially produce a profit. I think this is unlikely with stamps as opposed to, say, coins. We'll probably change that example in future versions of the textbook, I would think. But how it's described isn't the actual test. Because remember, somebody could describe something as a business, but it's really a hobby because it has no expectation of profit. And somebody could describe something as a hobby, but it's actually a business because it's very clearly making a profit. Right? It cuts both ways. Personal property, again, it's not necessarily for personal use, would be the definition here. Here, he's clearly buying it with the expectation of making a profit, right? So it's not. It's not that he's not trying to make a profit. It's that the kind of profit he's trying to make is a capital gain. And for capital gains, we cannot claim investment expenses. They're not investments in the usual sense. Sorry, that was a bit. You asked interesting questions there, and I like to clarify it there. Okay, the key point is it's a capital expenditure, and I think if we and it becomes clearer, say, if we are talking about, say, a coin collection or a bar of gold, then the nature of it becomes clear immediately. Is he likely to make money on this particular investment? Only if he really knows what he's doing, I would say. Now, is Charlotte required to report her bingo winnings? If so, please explain. But she's not required to report them. This is casual gambling. Remember, gambling winnings, lottery winnings in Canada are not considered taxable unless someone is a professional gambler. And there is no such thing as a professional bingo player. Right. Remember, this is not the case in all countries. If you go to the United States and win a jackpot in Las Vegas, the United States will happily tax you on that. But in this case, Charlotte doesn't need to worry about that. Now, 3, should the interest from the Bank of Nova Scotia be split 50-50 because it's a joint account? Good, guys, good. So remember, she only put in 1/5 of it, or 20% of the capital. So under the attribution rules, then the income is also, she's only 1/5 of the income will be attributed for her, right? So 1/5, 20%, so it's 80-20. The important point we want to stress here is that just because both their names are on the account, we cannot assume it is 50-50. The attribution rules always apply, and things should be split proportionately. Now, in the real world, sometimes couples may not closely track who has put what money into account, although if they are serious about investment in things, they will try to keep separate accounts and keep those things either quite separate or say, yep, this is a 50-50 account. But we should always ask what the actual percentage is. The important thing to stress, though, is the fact that they both have their names on the account does not mean it's 50-50. It does not mean anything in terms of the actual ownership of the contributions that went into the account. Remember, it is entirely possible to have an account where two people have their names on the account simply for inheritance purposes or access to the account purposes. It could entirely be 100% of the money in that account was contributed by one person. We cannot assume anything about the ownership of the account based on the names of the people that are on it. I even occasionally see accounts where it's still in the name of a deceased person or something like that, but the ownership is passed on to the new person or something like that. So whoever is reporting the income, it should be proportional to how much money they put into the account, their ownership of it. It doesn't mean, of course, that I don't sometimes get people who are confused about the exact proportions. And I did have one memorable client who was confused as to why her husband's name was also on the account. And I had to explain that, well, this was because presumably you and your husband agreed to that. That was a very interesting day, that one was. But yeah, point is, we can't assume anything about joint accounts based on the names on the slip. It has to be what the clients tell us about the amounts contributed. All right, now number 4, which medical expenses, if any, should be claimed? Now, we don't need to worry about the total, but yes, the dental and the eye classes we can definitely claim. Right? The $150 spent at the spa cannot be deducted, even though it was suggested by a doctor. If you look at the list of medical expenses on the CRA website, which can be claimed, you will notice that some expenses can never be claimed, even if prescribed or recommended by a doctor. Some expenses require a doctor's prescription or certification, but some can simply never be claimed. A blood pressure monitor, for example, even with a doctor's prescription, cannot be claimed. So in this case, the dental expenses and the optician can be claimed. Notice that either spouse can claim the medical expenses, and either spouse can claim the charitable donations. After the pension income splitting is performed, we would want to determine who it would be most beneficial for. In this case, after the pension income splitting is performed, Charlotte's taxable income would still be less than her non-refundable tax credits, depending on how you split the income, of course. But after the pension income splitting, Charlotte still would not be able to use these, so the charitable donations and the medical expenses would be claimed by Joshua. Now, can all of the donations be claimed? Good. We'll look at Schedule 9 on the next slide, but all of these donations can be claimed. Now, how does Joshua report his Social Security pension on the tax return? There's 2 important points we're looking for here. How is it reported? Remember, there's a special treatment for U.S. Social Security pension. Okay, so excellent. Yes, so the full amount is reported on line 11500, and then the 15% exemption, 15% of the line 11500 amount for the U.S. Social Security pension is deducted on line 25600. 25600, I think. All right. But yes, exactly, Beanish, you have to convert it to Canadian dollars before you run that calculation. The all amounts on the Canadian tax return on the T1 have to be in Canadian dollars. Some software packages for some things will automatically run this conversion for you. but you do sometimes need to double check to make sure that the conversion has been run. And if not, you will need to input it manually with the correct number. Not to worry, Daisy, not to worry. Okay, so looking at the Schedule 9, it's relatively straightforward. So all the donations are totaled up and entered at the top. Notice there's no exotic donations going on, no foreign charities, anything like that. So the total eligible amount of donations is $390. We then calculate the donations limit based on the net income. So the donations limit is $30,496 some odd. This is, of course, much higher than the donations. This means the entire amount of the charitable donations can be claimed. $200, the first $200 is going to get credit at 15% down here. Here we go. And the remaining $190, because his income is not in the top bracket, that it is less than $246,752 for the year, his remaining $190 gets credit at 29%. So 29% of $190 is $55.10. 15% of $200 is $30 for a total of $85.10. $85.10. There we go. All right. Okay. There we go. There we go. Okay, good. No questions there. Now, the big thing with 11-1 is the T1032. So I'm going to walk you through the form. Let's look at our time here. We'll get as far as we'll finish the form, and then if you have more questions, you can send them to me later, because I do want to at least get on to 12-1, at least a little bit. So for the form T1032, then, on the first section, we enter Joshua as the transferring spouse with his address, social insurance number, postal code, and then we enter Charlotte as the receiving spouse. And notice we don't need to enter her home address because it's not different from the above address. Then, in step 2, we calculate the maximum split pension amount. So, if we do the total up all the eligible pension income from the return, including the U.S. Social Security pension, he has a total of $22,406.79 in eligible pension income, which can be split. This section here is if you have unusual retirement type payments. So RCA payments or veterans benefits, these are calculated here. In this case, they do not apply. So there are no veterans benefits or RCA benefits. So the line 3 amount is the amount we're simply going to use, $22,406.79, because there's no RCA benefits or veteran benefits to be added in here. But that's what this section of the return of the form is about. Then there's a proration field. This applies if someone is only married or common law for part of the year. So you take a fraction, the number of months married or common law over the number of months in the year, multiplied by the amount above, the $22,406.79. So that fraction of that amount is what can be split. Now, in the case of a deceased partner, obviously they are not living together for 12 months, but also the tax year is also not a full 12 months for someone who is deceased. So instead, the 12 is replaced with the number of months up to and including the month of death. So the tax year would be, for someone dying in August, would be 8. And so if you were living with someone right up till the time they died, it would be 8 over 8. So again, it would be prorated accordingly. What basically then happens is we take the pension income, and up to 50% of this can be transferred. So the maximum split pension amount is $11,203.40. In this particular example, when we run it through our software, the optimum amount chosen by our software is 56.6550. If you're doing it manually, it can be hard to land on the optimum number, but this takes in various factors. In general, the optimization number is based on what will create the largest total refund or lowest balance owing for the couple as a whole. So that's how we came up with 56.6550. And so when you come to the end, you would want to ask, does this make sense? Does this seem reasonable that they're getting the result they are, the refunds that they are, and if we have any tax tips for them. So Valerie, you found they got a better result with the full amount? $352 more. I wonder if there was something else that offset it. I'm not the person who is working on the solutions side of things. Wonder if there was some other consideration, such as GST or something. As you can imagine, guys, it can sometimes get quite complicated figuring out what would be the most beneficial amount to claim. That difference of $350 is relatively small, given that the difference between claiming the full, and again, the full amount here. So the full amount would be 11,203 versus 5665. So uh, almost a $5,000, an over $5,000 shift in income produces only a $352 difference. That's interesting. I haven't had a chance to check it myself. I will look into that. So I'll see if I can come back to you with an explanation of that. 352.05 to be exact. Well, very good. Shoot me an email about that to remind me. I do have a lot of other things to catch up on, but I am curious about that. It does, because it's not obvious to me how exactly that optimization is arrived at. But often when I am optimizing for a couple, particularly if the software is giving fuzzy results, I will have to play around and put in slightly lower and slightly higher amounts, uh, and this is a general principle in tax, not just for pension income splitting, but put in slightly lower amounts, slightly higher amounts until you minimize, maximize until you're getting the very most back. Okay, you sent one yesterday? Excellent, Valerie. Thank you.